Hi, folks. I'm Luke Swetland, President and CEO here at the Museum and the Sea Center. Welcome to our first Lunch and Learn webinar of 2022. Throughout our more than 100-year history, the museum has been committed to education, and we're pleased to offer a wide variety of programs, many of them now virtual, including today's workshop, Understanding New Retirement Account Rules. The last 2 years have caused all of us to think a lot more about our own health, our mortality, and what kind of legacy we wish to leave. So this will be an information-packed hour that will provide a lot of useful insights and advice. Thank you for your attendance and for your interest in the museum. Of course, I hope you might consider leaving a gift to the museum in your estate plans to help ensure that this great institution is here to help generations of visitors, young and old, both learn and to thrive. I want to share just a little bit about what's happening at the museum. We've been making repairs and improvements to our exhibits at the Sea Center, and the Sea Center will be reopened on March 12th. The second floor has been completely reimagined, and I think you'll be very pleased with the changes. Over here at the museum, prehistoric forest with animatronic dinosaurs has become a must-see when you visit the museum. We have a great exhibit in the Maximus Gallery called What's in Our Drawers. It features our curators and the stories about the work they do. And of course, we're hard at work planning for a great summer of exhibits, and I look forward to seeing you here at the museum and at the Sea Center. Again, thanks for being here. Now I'd like to introduce my colleague, Caroline Baker, the museum's Director of Development. Caroline?
Good afternoon. I am Caroline Baker, as Luke said, the museum's Director of Development, and we're happy to share with you this free webinar with helpful information on individual retirement accounts and how you might use them in your estate plans. We will start with an introduction by our Planned Giving Advisory Council Chair, Denise Stevens, and then a presentation by our expert speaker, Michael Jones. Time has been allotted at the end of Michael's presentation for questions as well. Please place your questions using the chat function, which you should see at the bottom of your screen. A handout was included in your email yesterday. Also, I will send a link to the recording in a couple of days in case you missed something. If you should have any technical issues during the program today, please email Allie Nygaard, and she was my associate who sent the email yesterday, so you should have her email address. And feel free to reach out to me as well if you have any plan giving questions or need more information from me or the speakers. I'm here to help you leave your legacy, and hopefully you will keep the museum in mind in your planning. Now I would like to introduce Denise Stevens. Denise is a former institutional trust officer, a financial advisor, and a planned giving professional. She joined the museum's Planned Giving Advisory Council in 2017 and has been serving as the chair since. We are incredibly grateful for her guidance and leadership with the museum's Planned Giving program. So Denise, I turn it over to you.
Hello, everyone. We are just delighted and honored to have Michael Jones with us today. Michael's a partner in the CPA firm of Thompson Jones in Monterey, California. His focus is on trust and estate tax matters, and he's widely respected among his peers in the area of estate planning for retirement plans. This includes maximizing the value of inherited retirement benefits and tax-efficient wealth transfer strategies in general. He serves as chair of the CPE Forum of the Central Coast and formerly served as chair of Trust and Estates Magazine Retirement Benefits Committee. Mike has lectured across the U.S. for the Jerry Kasner Estate Planning Symposium, the Southern California Tax and Estate Planning Forum, Hawaii Tax Institute, AICPA Advanced Estate Planning Conference, UCLA CEB Estate Planning Institute, the New York University Institute on Federal Taxation, and others. He's also authored several books, published over 100 articles on advanced estate planning issues, and has been quoted in Forbes, the New York Times, the Wall Street Journal, Bloomberg Financial Reports, among many others. He frequently provides continuing education lectures to other professional advisors, and does community outreach like this as well. Today's topic is indeed timely, given the impact of recent legislation. Michael's going to hit some of the highlights given our time constraints, but as Caroline said, please feel free to use your chat function. This is not legal advice, but we hope this gives you a basis to help guide you further in your planning based on your own needs and circumstances. Let me now turn the floor over to Michael.
Thanks very much. I appreciate that wonderful introduction. It's very nice to be here, and thank you for inviting me. Hopefully, I'll give you a couple of things somewhere along the line that you can use in your own situation. When it comes to inherited IRAs, it's sort of what the working people use to accumulate wealth. And in a lot of cases, it will dominate, be maybe a house and an IRA, a few other things, but it will be a very significant part of an estate. And so we want to think about, well, how can we prepare our heirs, if you will, to make the most of it? Because there is this thing that I call the instant IRA withdrawal syndrome. So there's this commonly held belief about retirement account benefits. And that is that, for example, a $500,000 IRA is really only worth $250,000 because of taxes. Well, that's only so if the account is withdrawn in full soon after the IRA owner dies. Withdrawing no more than what's required, however, provides greater value because income taxes are paid later. In other words, what I'm saying is that deferring income taxes has value because you get to continue to build inside the IRA with continued tax deferral. So Congress knows that. So it mandated what are called required minimum distributions, and they are just what they sound like. There are distributions that are required every year after a certain point of time or after death. And those distributions are dictated by tax law, including regulations. So it subjects to tax deferred retirement accounts to income taxes on a scheduled basis. The retirement accounts that are subject to required minimum distributions include individual retirement accounts, individual retirement annuities, which I'm not going to talk much about at all today, and employer-sponsored retirement plans, including defined contribution plans, which essentially are savings accounts, and defined benefit plans, which essentially pay an annuity over a covered employee's retirement years and often going on to a surviving spouse. Roth IRAs, which don't produce taxable income, are also subject to required minimum distributions, but not until after the Roth IRA owner dies. So a Roth IRA owner does not have to take out required distributions during lifetime, but the beneficiaries do after the Roth IRA owner dies. The Roth IRA post-death required minimum distributions reduce and eventually eliminate the tax-free return on investment that Roth IRAs enjoy. So today's discussion is going to exclude annuities and defined benefit plans. We're going to just talk about the account type plans. So going on and talking about lifetime distributions, required minimum distributions have to begin on or before a date that Congress set. And that date is formally called the required beginning date. And some people will just say it RBD, but it is the required beginning date. It's keyed to an age. Before we got the Secure Act in late 1999, it was April 1st of the year after the year when age 70 and a half was attained. The Secure Act increased that age to 72. So that means those folks who hadn't started yet could wait a couple more years until that later age. So the other thing that's good to keep in mind is that in 2020, Congress completely did away with that year's required minimum distribution. There is no required minimum distribution for 2020. And Congress did that as a part of its legislation in response to the coronavirus epidemic. So as an example, I have in your materials of Charles, or just call him Charlie. And Charlie is married to Lisa. He has an IRA worth $100,000, and Lisa is less than 10 years younger than Charles. Well, you go to standard tables. Charles finds out that for 2019, his applicable divisor was 25.6 years. And that's the divisor again from IRS uniform tables. And you can find that in IRS publication 590A. So Chuck's required distribution is $100,000 divided by 25.6, which is equal to $3,906.25. Now note, and this is very important going forward, those tables that are used for required distributions have been revised, and they went into effect this year, and they have longer life expectancies. And so it tends to keep you in the situation where you can have slightly lower required minimum distributions than we were required to have under the tables that just got replaced. So as a consequence of the Secure Act, a significant number of beneficiaries won't be able to stretch distribution based on a life expectancy table. On page 5, I talk a little bit about surviving spouses because they get special treatment. When you have an employer plan, the spouse is deemed to be, in other words, we pretend that the spouse was an employee, so that after the surviving spouse dies, the next taker is treated as the same as the death beneficiary of an employee or an IRA owner. So that's a nice rule to be aware of. So on page 5, I've got the pre-Secure Act rule for death on or after the required beginning date. And I'm going to go through this because there are people who still get to use it. So what you do then is use the life expectancy of the designated beneficiary, or if longer, the remaining life expectancy of the person who is the same age as the participant or the IRA owner. In other words, the beneficiary is older than the plan participant. If there's no designated beneficiary, we either have the 5-year rule, which means that all the money has to come out of the plan or the IRA within 5 years of death, or alternatively, the remaining distribution years that the participant or the IRA owner would have had. But in that case, you just keep subtracting one every year. You don't keep looking up the divisor every single year. So on page 6, I have a graph or a chart to depict this. So you can see that I have a timeline going from left to right. And the required beginning date is somewhere in the middle. That's that vertical arrow. And so as we're going along in time along the left side, if death occurs before the required beginning date, you really get the 5-year rule if there's no designated beneficiary. And if there is a designated beneficiary who qualifies, then you get a life expectancy treatment. Again, these are the old rules. And some beneficiaries still get to use these rules. So this is not dead mail. If you had death on or after the required beginning date, notice there's no more 5-year rule anymore. You either get the life expectancy of the designated beneficiary, or if there is no designated beneficiary, you get the decedent's remaining stretch years. And this is what Secure Act has stepped on. With the new tables, the preamble that comes along and discusses what the new tables are all about, it says that all qualified plan participants and all IRA owners are required to begin using this new table this year in 2022. Eligible designated beneficiaries of all qualified plan participants, and those are the new rules, people who can still use stretch after death, eligible designated beneficiaries. Of all the qualified plan participants and all IRA owners who died during 2022 or later do have to use the new tables. So any person who inherited an account before 2022 has got to adjust the applicable divisor, and this one is tricky. In this situation, in order to derive the 2022 applicable divisor, the beneficiary must now pretend that the new tables were in effect before 22, during and after the year when the account owner died. So now, let's say that Alice died during 2018 and Barbara is her beneficiary, and Barbara inherited Alice's retirement account. In 2019, Barbara's divisor for computing her required minimum distribution was 13.4 years based on her age of 75. In 2022, Barbara's divisor was going to be 10.4, but the new tables apply from 2020 on. So what does Barbara have to do at this point? Well, Barbara now has to look up her applicable divisor for a person aged 75 years, which is what she was back in 2019, and then subtract 1 for every year since 2019. So under the new table, the 2019 applicable divisor would have been 14.8. Now, for 2022, Alice subtracts 3 from the 14.8 years, and now her 2022 applicable divisor is 11.8 years, and it will get reduced by 1 every year after 2022. Now let's move on to the Secure Act. The Secure Act did a bunch of things to required benefit retirement benefits, both IRAs and qualified plans that are sponsored by employers. First of all, it raised the age, triggering when lifetime required minimum distributions must begin. It was previously keyed to the date when 70.5 was attained. And then the first required distribution was due April 1st of the year after the year when 70.5 is attained. I've always been amused that they picked April Fool's Day for this, but we won't go into that too much further. So at what point in time does the Secure Act apply? Well, the answer is that the Act, as it was written, says that its rules, and I'm quoting, shall apply to distributions required to be made after December 31, 2019, with respect to individuals who attained age 70.5 after that date. So if age 70.5 was attained during 2019 and the plan participant or the IRA owner died before April 1st of 2020, Secure does not apply to the account's beneficiary. That means the 5-year rule and its exceptions apply, granting stretch distributions. The Secure Act 10-year rule I'll discuss next won't apply in this case. So the Secure Act kept the 5-year rule. But what would have been the exceptions to the 5-year rule have been stepped on pretty hard at this point. It severely limits an inheritor's stretch distributions after the employee or the IRA owner dies, except for a beneficiary who qualifies as something that the Internal Revenue Code calls an eligible designated beneficiary. So it's no longer enough just to be a designated beneficiary, you must be an eligible designated beneficiary. That beneficiary is not forced into Secure's 10-year rule. The beneficiary can use stretch. So who are these lucky folks called eligible designated beneficiary? Well, the list is fairly short. It consists of a surviving spouse. And then the next one is a person who is a minor, in other words, has not reached majority age. But when majority age is reached, then the 10-year rule applies. So once I get to age of majority, I've got 10 years to get it out. Now in California, the majority age is 18 years. And so you've got a pretty young majority age here. It's later in some other states. The next eligible designated beneficiary is a disabled person, and there's a long definition on that for what is disability. The next EDB is a chronically ill person, and in order to qualify, that person has to get certification as to the fact that he or she is chronically ill. And then lastly, any person who is not 10 years younger than the participant. So for example, if it went to my sibling who is 7 years younger than I am, my sibling would be able to use the stretch years as the beneficiary, and would not have to live with the 10-year rule. Another one would be a parent or a cousin who would likely, be with not 10 years younger. So the new timeline is on page 13, and I graphed that out for you. And again, in the middle of this graph, you've got the required beginning date. If you have death before or before the required beginning date, it's the 5-year rule or the life expectancy of an eligible designated beneficiary. Now, I want to point out, when it gets to Roth IRAs, Roth IRA owners always die before reaching the required beginning date, because Roth IRAs don't have required minimum distributions during lifetime. So the inheritors of a Roth IRA are always in the situation that I just described: 5-year rule or life expectancy of an eligible designated beneficiary. If you have death on or after the required beginning date, now you've got the 10-year rule, or if there's an eligible designated beneficiary, that person gets to use life expectancy. So what rule applies when the participant or the IRA owner died before 2020? There was a designated beneficiary, so distributions over lifetime were allowed, and the designated beneficiary dies after the Secure Act's effective date. Well, the answer is the 10-year rule applies regardless of who that successor beneficiary is, and that's in Secure's enacting legislation. Sadly, although it's in the enacting legislation, in other words, it's in the bill that Congress passed, they didn't put it in the Internal Revenue Code. It's not in the tax law. So let's hope that the Treasury incorporates that into regulations so that practitioners and people who inherit IRAs don't miss that point. So moving on to page 13, when is the date for determining the eligible designated beneficiary? The Secure Act did not change the point in time for determining a designated beneficiary. So as it was before, we've determined the designated beneficiary, if there is one, on September 30th of the year after the year when the plan participant or the IRA owner died. Now, you can change the result a little bit if somebody who is a beneficiary and would get you into a bad result from a standpoint of required distributions wants to walk away from what they have. It's called a disclaimer. A disclaimer is basically a written document saying, I'm raising my hand to say that I don't want what I have coming to me. So a beneficiary who makes a disclaimer is treated for all tax purposes as though that beneficiary died before the required account owner died. So then we look for the designated beneficiary or the eligible designated beneficiary, just as if the disclaiming beneficiary died before the plan participant or the IRA owner died. It just creates a legal fiction that takes that person out of the running or even out of consideration for a designated beneficiary. And if there's no designated beneficiary and death occurred before the required beginning date, again, the 5-year rule applies. If death occurred on or after the designated beneficiary died and there's no eligible designated beneficiary, then at that point, the 10-year rule applies under the new rules. So again, if there's an EDB, an eligible designated beneficiary, the old life expectancy rule that I discussed earlier is available. So the next question is it possible for an eligible designated beneficiary's successor to qualify for EDB status? And the answer in short is no. If an eligible designated beneficiary dies before the inherited retirement account is entirely distributed, the exception from the 10-year rule that's available for eligible designated beneficiaries does not apply to any beneficiary of the first beneficiary, no matter who you are. Instead, again, you've got that 10-year rule, and it's got to be out within 10 years of when the first eligible designated beneficiary died. On page 17, we're going to get into some special rules for surviving spouses. And Congress has a policy of looking at spouses as being a part of a single economic unit. And so in consequence, they give us a very nice rule for what is called a required commencement date, which is the date when a surviving spouse has to start taking required distributions. So before the Secure Act, it was December 31st of the year after the year when the participant died, or if later, the date when the decedent, who was the participant, would have attained age 70 and a half. And that's the attained age to which the participant's lifetime required beginning date is keyed. Post-Secure Act, that age 70 and a half got increased to age 72. So for someone who would die today, we would do the same drill, only we'd fill in the age 72 and stage 70 and a half. So that brought up a question, which, by the way, the regulations haven't addressed yet. If the participant died before the Secure Act's effective date, and the participant's surviving spouse is the sole beneficiary, and the surviving spouse survived their participation, then in that case, is the required commence date still pegged to 70 and a half, or do we get to raise it to Secure's 72? The Congress hasn't told us what to do about that, and the Treasury hasn't yet told us what to do about it in any form of guidance, such as regulations or otherwise. Or can the surviving spouse take the position that because the Secure Act, reset to 72, you could peg to 72? Well, I think the answer to that is the law in effect when the participant died is going to control. So it seems doubtful that Congress intended to change how the required minimum distribution rules applied to anyone who died before the Secure Act effective date. But again, watch for that in guidance. We hope that Congress will tell us what's up with that soon. Okay, going on to a child who's a minor. A child is going to have comparatively low required minimum distributions because they have very long life expectancy. So for example, a 7-year-old's applicable divisor is 74.8. You divide that into any number, you're going to get a comparatively small number. It's 1/75th basically. But if the child reaches majority, or after the child reaches majority age, at that point, the 10-year rule kicks in. One question I think we need to have addressed in regulations is, what if that retirement account's death beneficiary is a trust, and the trust benefits a minor child, and the trust is a minor child, is a grantor trust with regard to a minor? What do I mean by grantor trust? There's a set of rules in the Internal Revenue Code that says that I can put property in trust, and if I keep or have certain rights in that trust, I'm treated as though I own the property that's in the trust, but only for tax purposes, not for state law purposes. So that's called a grantor trust. Could a beneficiary become a grantor of a grantor trust and so get to use the exception of the 10-year rule? We don't know. Hopefully we'll get guidance from that on Treasury as well. So you can see, as Congress often does, they write tax laws, they don't fill in some of the blanks, and then Treasury has to come in and clean up after them. So here's a question about maximizing after-tax value of what you get as an inheritor. So the question is this: when the 5-year rule or the 10-year rule applies, should all beneficiaries wait until the last day before withdrawing the plan assets? In other words, gee, I'm getting tax deferral, why shouldn't I just make the most of it? Well, the answer to my question is, like so many things in life, that depends. You probably heard that from your third grade teacher many times. If the beneficiary is not otherwise paying taxes at the top rates, it might be most valuable to withdraw every year just enough to utilize the lower income tax brackets. And to evaluate that, it would be a good idea, I think, to develop a detailed financial model that compares the alternative, including computation of translating future value to present value So we're dealing in today's dollars when we're making that decision. So note one other thing, and Natalie Choate, who is probably the best authority in retirement distributions and has written the best authoritative book on this whole subject, life and death planning for retirement benefits. So when the 10-year rule applies, you get 11 years of rate run-ups that are available. Because, for example, you have 2022 and add another 10 year through 2032, you're going to find out that you have 6 years to work with. So again, after-tax present value is the best tool for assessing which alternative is likely to be the best. So I put an example on in your outline. I'm sorry I don't see what page that's on right now. But I show it here, and you'll look for a grid where you have an initial value of $500,000. And assuming that you're earning about 7% per year before paying income taxes, and roughly a 33% effective income tax rate between federal and state. The value in 10 years before income taxes would be about $984,000. The value in 10 years after paying income taxes at the end of 10 years is about $621,000. So the deferral was worth net about $362,000. And again, as I mentioned, you could do better than that by running the rate scale every year in the first 9 years. So I've included commentary on various aspects of naming trust as beneficiary. That is probably one of the most complex things to do. It is possible for a beneficiary of a trust to be counted as the beneficiary of an IRA or a qualified plan death benefit for purposes of required minimum distributions. Just understand that that's possible, but the trust has to be very, very carefully done. And you would go to sleep in the next 3 minutes if I even start on that subject. So I'm just going to tell you that that's there and you may want to look at it. And people do want to look at it because often they leave money in trust because they don't want someone to have actual, complete control over property. They want them to get it slowly. So it does make sense to go down that road in many cases. So let's say that I'd like to give now some of my IRA money dollars to a charity, for example, the Santa Barbara Library. Well, the IRA rules permit me to have my IRA make out a check to the order of the Santa Barbara Library while I am living. So I can do it now, and that's kind of fun because then they can thank me. It's even more fun because I'm actually still alive. So when you make that direct transfer from the IRA to the Santa Barbara Library, provided that my age at the time of the donation is at least 70 and a half, I do not have to go through the drill of taking that distribution into my income, report it as gross income on my income tax return, and then turn around and have to take a charitable income tax deduction. Instead, no part of my donation is treated as a taxable IRA distribution. Now that's nice because getting a charitable deduction is probably harder for some people than it is for me to grow hair. But there's a limit to how much I can donate. That limit is $100,000 each year. So the way that works is a direct transfer is treated as though 2 steps occurred instead of 1. Step 1 is the donor is treated as though the donor took a distribution. And step 2, the donor is treated as though the donor made the distribution and not the IRA. That's if you don't qualify for a qualified charitable distribution. Not a good idea. So summing up, setting up one IRA to go to charity is something to consider. And setting up a different IRA to go to family is something to consider, although you can do both of those things in a single beneficiary form. Another possibility is to leave some of your retirement account to a charitable remainder trust. A charitable remainder trust is a special kind of trust which is provided for right in the Internal Revenue Code. So a CRT isn't something that Mike Jones made up. It's something that Congress said you can do. Here's how it works. A charitable remainder trust makes payments to individuals such as family members. And when those payments end, all the funds held in the charitable remainder trust are then paid over to one or more charities. While money is in the charitable remainder trust, no income tax is paid. So if my $500,000 IRA names a charitable remainder trust as its beneficiary, that means that when the money goes from my IRA after I die to the charitable remainder trust, there's no tax on any of the IRA dollars at that time. It only is taxed when a non-charitable beneficiary, in other words, one of my family members, gets a distribution during lifetime from that trust. So I have included at the end of your outlines some critical dates that have to be observed post-death that you need to take care of. So I'm going to ask our friends who are hosting me here to pose any of the questions that they would like to have me answer at this point. If I can hear you. What do I have to do to hear you?
Thanks, Michael. Yeah, we do have some questions that came up in the chat. First one asked, if you are an existing IRA beneficiary using Table 1 in the past for RMDs, does one now use the new 2022 tables before we use the initial Table 1 plus 1 for each new year?
Okay, so now what you're going to do is you're going to go back to the first year that you got a required distribution. And you're going to take that and you're going to recompute it. Now, this is not the amount that you're going to take out right now, but you're going to find out what would the divisor have been in that year if today's new tables had been in effect back at that time. And then you go forward, and there's an example of this in your outlines, by the way. Then you go forward and you adjust that every year until you get to the present year. And that is the one that you're going to use going forward.
Awesome, thank you. So we have another question. Can you transfer an inherited IRA to a new custodian?
Yes, and let me talk to you a little bit about the two ways that you can do that. I'm going to give you the way that I prefer first. Let's say that I have a $100,000 IRA with custodian 1, and I have been contacted by someone from custodian 2 who said that, you know, we feel that we have a better model, and we're also going to give you maybe lower fees, and perhaps we'll give you a bag of popcorn on the way in the door. So how would you like to move it over? And I go, gee, that sounds pretty good. Do I still get to decide what my own investments are? Oh, yes, you can do that. You'll have all the same rights as you do during that time. So the best way to do that is to set up the IRA with the new custodian. And now you have an empty IRA with the new custodian. And then the next thing you do is you go to your old custodian who has the IRA that still holds all of the IRA money. And you give them the account number and the new custodian account number, the new custodian information, and you have them make a direct transfer by wire from the old custodian to the new custodian. Now, the reason that that is helpful is because you don't wind up with an IRA distribution in your hands, and you have no risk that you will somehow get to day 61 when you can no longer make a rollover, because you only have 60 days to make a rollover. And there are court cases where someone said, oops, I missed one reason or another. And the courts have consistently said, Congress did not give you any wiggle room. If you don't make the 60 days, sorry, Charlie, so sad. Too bad.
Let me just add a little to that.
Yeah.
From that financial planning background. So you can also do a direct transfer of assets if the If the inherited IRA is holding mutual funds or stocks and you open a self-directed IRA with a different custodian, you can transfer them as is. All of that is on the designated transfer form to transfer in kind. Make sure that the new custodian can hold those assets if that is your intent. The other thing the new custodian will do, since it's a beneficiary IRA that goes by these IRS distribution rules that are now a little more draconian, is they ask the date of death of the original IRA owner. They note that in the account, and that drives the rules of that account, and you can't add money to it. It is segregated from your other IRA accounts. It is designated as a beneficiary IRA.
Thank you, very helpful.
Thank you, Michael and Denise. So another question that we got, if your child who is more than 10 years younger than you is your Roth IRA beneficiary, then do they fall within the 5-year rule?
Yes, they would, because the Roth IRA owner can't die after the required beginning date, because the Roth IRA owner has no required minimum distributions during lifetime. So yes, the 5-year rule always applies for Roth IRA unless you qualify for one of the exceptions, and they're mostly gone. You'd have to be an eligible designated beneficiary.
Awesome, thank you. So another one we got, is there ever a circumstance that you can withdraw money early without penalty?
Okay, first of all, the penalty applies if it's your own IRA and you take money out before you got to age 59 and a half, there's a 10% tax on that. So you don't do that. That does not apply to beneficiaries. So your beneficiary could be 30 years old and the death beneficiary can take money out without worrying about that 10% tax.
Thank you. So it looks like we have another one just came in. Is there a rule of thumb for determining whether to roll over a Roth IRA and pay taxes now so that beneficiaries won't have to pay taxes on required distributions?
I'm not sure I understand. Would you please state that one more time?
Yeah. Is there a rule of thumb for determining whether to roll over a Roth IRA and pay taxes now so that beneficiaries won't have to pay taxes on required distributions?
Oh, so so if I understand you correctly, I am an IRA owner. Does it make sense for me to roll over to a Roth IRA during my lifetime so that my beneficiaries don't have to pay required distributions?
A Roth conversion.
Yeah, that's called
Yes.
a lifetime Roth conversion, and the answer to that generally is yes. But again, you've got to consider the 10-year rule, and so you probably wouldn't get as much value out of stretch as you did before. It's one of those things I think I'd probably want to get out my spreadsheet and evaluate on a case-by-case basis.
And also consider who the beneficiary is. For example, if I've named a charity as the sole beneficiary of my Roth, it's my understanding, of my regular IRA, it's my understanding that converting to a Roth doesn't have the same value because my regular IRA is going to a charity who won't have to pay taxes on it.
Right, and that basically in the mix of things, that's going to make your individual inheritors a little less wealthy.
So in that scenario, Michael, let's say you have both an individual and a charity named. Does a Roth make sense? Can you do a partial rollover? Partial conversion?
Yeah, Roth conversion is not all or none. If I had a $200,000 traditional IRA and I wanted to convert 100,000 of it to a Roth, I can do that and keep the other one as a traditional. Then I could leave that one to charity. There won't be any tax on it.
Thank you. So another one we have, if you inherit an IRA under new rules and then you die, does your beneficiary get the 10 years or is it accelerated?
It's the 10-year rule would apply to the next beneficiary.
Awesome. So the next one we have, from a tax perspective, when is the best to withdraw from a Roth versus from an IRA?
Well, the best time to do it is when you don't have to do a Roth conversion, is in the year when you expect your taxable income to be relatively low. In other words, in a year when you're not in the top tax brackets. And so it could be, in some cases, that you might slowly do Roth conversions over several, if not many years, so that you're not paying top tax rates to do that.
Great advice. We also have, let's see. Can I give through my IRA to my donor advised fund?
You can leave an IRA to a donor advised fund at death. I hesitate because there's a lifetime rule, because you can make a direct transfer to charity during lifetime, but that can't be good to do a donor advised fund. So it's a weird rule. You can do it at death, but not during lifetime.
And what is the maximum that you can give to a charity through your IRA?
I don't think there is a maximum.
Okay, but can you talk briefly about the $100,000?
Oh, the $100,000, I'm sorry, for direct transfer from an IRA. Yeah, there is a $100,000 limit, and that is lifetime.
And that can be made for those over the age of taking required minimum distributions, can be made directly to a charity where they don't have to then assume the income for that distribution.
Yeah, let me name the demon here, because it was 70 and a half. And as I mentioned earlier, required distributions, required beginning date went up to 72. The age for making qualified charitable distributions from an IRA to a charity is still 70 and a half. They did not tinker with that age in that, since now we have two different ages for two different situations.
Something that many people are finding out once they have to start taking their distributions is it impacts that income impacts their tax bracket, and there's a Medicare surcharge tax. Can you talk briefly about that?
So what you're referring to is that there are a number of things that are keyed to your adjusted gross income. And as you get higher adjusted gross income, then you lose benefits of one kind or another. So that's, that is what it is. Your adjusted gross income also becomes there are things you can do for tax purposes that are keyed to your adjusted gross income as well, such as contributing to an IRA, and you have to watch that as well. But it's in practice, it just turned out to be, in so many cases, it is what it is. It happens, and then you just live with it.
So I recently inherited an IRA from my cousin who passed away a couple of years ago. I have to take distributions under the new rules. My husband has a state pension. We're in a higher bracket than anticipated in retirement. Many people are finding that as well. So I think this question was raised earlier. Looking at how I take that over the 10 years, if there is not going to be a low income year.
Yeah, so if you're always in the top tax bracket, then yes, I would wait the full 10 years to take it out. Or the full 5 years if that's what applies.
Thank you to both of you. Denise, did you have another question? I have one as well.
Oh, please. Is a 401k different, Michael? as far as the timelines when you have to take it, or it's under the same rules?
So a 401k is really treated the same as a qualified plan. In fact, they're the same, they're in the same code section. They're all 401 plans. So you, from a required minimum distributions perspective, 401k accounts are subject to the same required minimum distribution rules as regular profit sharing plan accounts.
Awesome. I think those are all the questions that we have so far. If anyone has any additional questions that they would like to ask Michael, they could either reach out to him directly. We'll post a slide at the end of the presentation with his contact information, or you could reach out to Denise or Caroline Baker as well.
I'd like to just leave one other nugget, food for thought. People talk about what is equitable, and that can sometimes become an interesting question, because you might have named beneficiaries that are in different tax brackets and different earning potential. And so what is fair and equitable? Is it before tax, net after tax? Is it dividing? Is it looking at all of the assets and perhaps leaving taxable assets to one that is in a lower bracket and something else? So this is all part of the overall estate planning questions to ask oneself when sitting down with your advisors. How do I distribute?
So there's one other thing that was kicking around in my so-called brain. Oh, I know what it was. There's stuff in your materials about naming trusts as beneficiary, and then when the trust is going to make a charitable distribution. A trust pays income taxes, and it's a very, very flat run up the rate scale. So not very much money has to get into a trust's hands before there is an income tax to pay. And there is a possibility for a trust to get a charitable deduction. And I listened to a panelist at the McFarling Institute, which is probably the premier tax institute on trust and estates in the country every year, by Natalie Choate, who is probably the best person in this subject anywhere in the country. And she went through the hoops that you have to jump through to get a charitable deduction from a trust. It would almost be easier for me to grow hair than for a trust to get a contribution deduction for a charity. So the thing that you have to do is work very, very carefully with your tax planner so that you don't wind up with doing something that causes the trust to have to recognize taxable income and then get the money into the hands of charity. It's much better if the trust can have the charity set up an inherited IRA and then make a direct transfer from the trust's inherited IRA to the charity's inherited IRA. And then you've gone through the entire exercise unscathed. So with that, I'll bid you adieu. Thank you for having me.
Thank you so much, Michael and Denise. I think Caroline wanted to say a few words as well.
Thank you, Allie. And thank you, Mike and Denise. Mike, thanks for sharing such helpful information with our participants. We really appreciate your time and all of the information that you shared. Denise, thank you as well for your continued leadership of our Plan Giving Advisory Council and your help with this presentation. You both had just so much knowledge to share, and we really are grateful for that. And of course, Allie, thank you for running the show here and making it easy for us. Here is our contact information, Mike's contact info and my info if you have any additional questions or you'd like to talk about your specific situation. And of course, as Luke shared at the beginning of this presentation, I think all of us are thinking more about our own health, mortality, and what kind of legacy we wish to leave. As you consider your plans, I hope you might consider leaving a legacy gift for the museum, and I'm available to help with any questions you might have about that. Our next Lunch and Learn webinar is scheduled for June 14th, and the topic is the ins and outs of charitable gift annuities. Again, thank you, Mike and Denise, and thank you to all of our attendees. Have a wonderful day.